Hello everyone. Starting subject 3, Basics of Accounting and Managerial Accounting. This subject is divided in various modules. So in module 1, we will discuss basic terminologies used in accounting. Giving a brief overview, we will cover these terminologies used in video. The first of which is assets, then liabilities, account receivable, bills payable, provision, reserves, inventory, capital assets, revenue items, balance sheet, trial balance, profit and loss account, capital expenditure, current assets, current liabilities, dividend, net profit, depreciation, tax, debiting and crediting, money cost, real cost, opportunity cost, private cost, social cost, and sunk cost. So what are the assets? In simple language, we can say what one owns or the company owns for the business is known as assets. For doing business, a company or individual has to own certain items and equipments like office, machines, and motor car. They belong to the business and hence known as assets to the company. For example, table, chair, building, machines, car and delivery van, etc. These all are the examples of assets. So moving on to the liabilities. In formal way, we can say what a company or individual owes to other for business is known as liabilities. In the process of performing business operations, a company may borrow or may avail advance payment or receive goods on credit. These are the things for which the business needs to pay its due and hence known as liabilities. For example, telephone bill due, credit card bill statement, electricity bill due, advance payment received for executing order, loan received, raw material received without payment are all the examples of liabilities. Now moving on to the subparts of assets and liabilities. The first of which being accounts receivable, also known as sundry debtors, bill receivable and debtors. Above are some of the trade names or commercial names given for short-term loans owed by others to us or our company. Therefore, they should be classified as short-term assets in our accounts. Short-term, yes, because such are the dues for a period less than a year. The other being bills payable, also known as sundry creditors, creditors or accounts payable. The above are the reverse of what we saw as short-term assets, namely short liabilities. Like bills are to be received, they need be paid to. They are of short terms duration and may not normally exceed 1 year. Can you default electricity bill beyond 15 days? Obviously no. In a business, a company or individual may have to receive short-term credits for raw material or service before payment like telephones, electricity and water bills. These are short-term credits or loan owed and hence need to be accounted in any one of the above heads in an organization. Moving on to the next definition, which is provision. So an expenditure which is certain to occur but not yet exactly known and due can be accounted for as provision, like a car that has been given for a repair or a bonus that has to be paid. Reserves. From a net profit of a business, the amount set aside for general future safety of an organization is known as reserves. It is set aside only from profits. Inventory. So in a manufacturing industry, there could be a raw materials, semi-finished products, and finished stock. All these are classified as inventories. So are these assets or liabilities? Since the organizations or business own them, they are obviously assets. Now, capital assets or fixed assets. So these are the assets which are used by the business for a very long durations. These are the fundamental productive purposes of goods or services like machines, building, furniture, fixture, land, etc. They virtually continue to exist in the organization for a very long term. Now, revenue item. So expenditure that are associated with day-to-day manufacturing or rendering services like stationery, oil, water, waste cotton, fuel, etc. are all the revenue items. Now moving on to the balance sheet. So these are basically a financial statement showing at a point in time where the money came from and how it is currently invested. Now, trial balance. When on a particular date, one draws the position of assets and liabilities of a company without making the required adjustments in income and tax, etc., it is known as trial balance. A balance sheet or trial balance can be drawn for a day or rather drawn as on a particular day. Now, profit and loss account. While balance sheets are drawn as on a particular day, the profit and loss could be drawn only for a period of performance, say 3 months, 6 months or 1 year. It is the annual profit and loss, all the adjustments required for taxation and other statutory provisions are fully made. In the modern parlance, balance sheet and profit loss account are together known as financial statements. However, the classical names still continue in usage. Now, capital expenditure. So all the expenditure related to the purchase or improvements of facilities or processes are capital expenditure. These are the fixed assets. Now, current assets. So basically, a current asset is a balance sheet items that represent the value of all assets that can be reasonably expect to be converted into cash within 1 year. Now moving on to the next, current liabilities. So current liabilities are the company debts or obligations that are due within 1 year or within a normal operating cycle. Furthermore, current liabilities are settled by the use of current assets, such as cash or by creating new liability. Dividend. So these are the part of earnings paid out to the shareholders in order to give them an income or return on their investment. Now net profit. So after deducting all the expenditures during the period of a year, or basically it may be 6 months or 3 months, as the case may be. So from the receipt, what remains for the investor is the net profit of the business. In the above amount, some portions will be paid out as dividend. The rest is share capital, share premium account, shareholders fund and working capital. Depreciation. When fixed assets are used in a business, they wear and tear. After some time, they need to be replaced or repaired. The amount used for this purpose is deducted as a fixed percentage of the cost of asset every year. This method of accounting is known as depreciation. There are several methods of providing depreciation like straight line, written down value method, etc. Tax. Tax is a legal statutory liability that need to be paid by the company or business to the government. They need to be paid compulsorily. Now debiting and crediting. So basically a debit is an accounting entry that either increases an asset or expense account or decreases a liability or equity amount. And a credit is an accounting entry that either increases a liability or equity account or decreases an asset or expense account. On and contrary, if you had borrowed from Citibank, then you will credit Citibank account in your books and they will debit your account in their books. So basically this is an mirror effect. Now money cost. So in simple language, money is spent to produce a product is money cost. And also when production cost is expressed in terms of monetary units, it is called money cost. It means the aggregate money expenditure incurred by a producer on a purchase, procurement and processing of inputs. Now real cost. So it is the overall actual expense involved in creating a goods or services for sale to consumers. And also it is known as the engineering cost and refer to the physical quantum required to produce a product. Now moving on to the opportunity cost. So it represents the benefit an individual, investor or business misses out on when choosing one alternate over other. Now private cost. So the private cost is the actual cost incurred in performing the day-to-day operations of the business, such as the cost involved in the production and consumption of the product. So this is the cost incurred by the individual private firm or company. Now moving on to the next, social cost. So basically social costs are the costs incurred by the social enterprises above and beyond ordinary business cost in order to fulfill its mission. The social cost is the cost related to the working of the firm but is not explicitly borne by the firm. Instead, it is the cost to the society due to the production of a commodity. Now moving on to the last term, sunk cost. A sunk cost is a cost that has already been incurred and cannot be recovered. When a project is undertaken in a swamp, the land development cost is sunk cost. This is an example of the sunk cost. So that's all for this video. Thank you.